We are in the midst of a historic housing crisis, but does that mean we're facing a foreclosure crisis? Amid swirling headlines and speculative forecasts, it's crucial to separate fact from fiction. This report embarks on a meticulous journey through the latest data and trends to uncover the truth behind sensational claims regarding foreclosures and distressed properties. Focusing on delinquency rates, foreclosure starts, and homeowner equity, this video delivers a comprehensive analysis that cuts through the prevailing narrative of doom. Are the alarm bells justified, or are we being subjected to a lot of clickbait and hype? I've heard the warnings and have assembled my responses to each in today's video so that you, the viewer, will be empowered to traverse your local housing market knowing what's to come with foreclosures. Join us as we dissect the numbers, challenge the hype, and offer a clear-eyed assessment of the housing market's current state. This is not just another commentary, it's a deep dive into the facts that matter. Our report begins with an analysis of the number of borrowers who were behind on their mortgage payments. After all, if the massive foreclosure crisis predicted by YouTube hypesters is to materialize, it will originate from the segment of homeowners failing to make their mortgage payments, right? The national delinquency rate increased up to 3.57%, up marginally from November, largely because December ended on a Sunday. This timing delayed payment processing on the last day of the month. The payments recorded after the end of the month weekend that were received on time will not be marked delinquent, even though they were included in the delinquency report. And while the increase of 5.6% was higher than the typical December rise of 1.4%, it was less severe compared to previous Decembers ending on a Sunday, which have historically seen delinquency surge by an average of 9.9%. Hypesters pushing scare tactics from the December report simply do not know what they're talking about. Delinquencies rose across all categories, with both inflows and progression to later stages of delinquency increasing, while recoveries from both early and late stages saw improvements. Most importantly, serious delinquencies climbed to 475,000 loans, but were still 19%, or 108,000 loans fewer than last year's levels. This graph analyzes the percentage of borrowers behind on their mortgage payments. After all, if the massive foreclosure crisis predicted by YouTube heisters is to materialize, it will originate from the segment of homeowners failing to make their mortgage payments. The black line charts the average delinquency rates from 2000 to 2005 for comparison, whereas the blue line represents the current delinquency rate among borrowers. The all-time low in delinquency rates was noted just over a year ago, with today's rate at 3.57%, only marginally higher than this historic low. Given that mortgage payments are being made at near record levels, why are we hearing about foreclosures on the rise? Roughly 96.4% of borrowers are current today, close to a 22-year high and perhaps even longer, though we do not have that data. So, if you're looking for a foreclosure crisis due to delinquencies, you will struggle as the market is nearly less delinquent than ever. If you're a longtime subscriber, then you know I often discuss foreclosures and short sales because tracking distressed properties is a great way to litmus test the health of the housing market. If you're not a subscriber, please click the thumbs up like button and subscribe now so that you get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to evaluate the facts and ignore the hype that's so prevalent online, then subscribe now and I'll keep you in the know. Another YouTube channel covering foreclosures suggested that lenders facing a downturn in the market are now eager to issue loans and have thus relaxed borrowing standards to meet quotas. This rationale seemed plausible, prompting me to collect data to assess the validity of the claim. My research revealed quite the contrary situation. In 2023, the number of borrowers with credit scores below 660 who successfully closed on their loans hit a 21-year low. Given the high numbers recorded from 2003 to 2007, this recent figure likely sets a record for an even longer period. It's evident that today, few borrowers with low credit scores are getting loans. I stumbled upon a recent report that concluded that loans established a few years ago, when interest rates were low, are performing well today. However, it suggested that loans issued in the past 2 years, carrying interest rates well above 6%, are lagging and will trigger the next wave of foreclosures. This theory seemed to make sense, prompting a closer examination of the data to verify these claims. FHA loans, representing less than 15% of the mortgage market, stand out as the only mortgage product with a higher delinquency rate than pre-pandemic levels. While VA loan delinquency rates have reverted to pre-pandemic figures, they're slightly higher than their levels at the onset of the pandemic. On the other hand, portfolio loan delinquencies are well below pre-pandemic levels, only marginally above their record low in August 2023. Early payment delinquencies, observed 6 months post-origination, have gradually increased for both FHA and VA loans in recent years, signaling a trend that merits close attention. However, we're much closer to record lows in delinquency rates than to a threshold that would justify hyped-up alarmist foreclosure reports. This graph plots the inventory of foreclosure homes for sale. Do you sense a foreclosure wave coming soon? Foreclosures currently account for less than 0.5% of all homes for sale in the U.S., despite warnings from alarmists about an impending crisis. Consider this perspective they may have overlooked. In 2009, the market saw nearly 2.5 million homes in foreclosure. Today, that number has plummeted to below 300,000. While there are many aspects to scrutinize when evaluating the state of housing, mortgage foreclosures should not be a major concern unless there's a significant downturn in the U.S. economy. The likelihood of a near-term surge in foreclosure activity remains low, as the volume of foreclosure starts is still nearly 40% below the levels seen before the pandemic. It appears that the primary motive behind the foreclosure warning videos is more about attracting views to clickbait channels than providing a factual assessment of the housing market's health. This graph displays foreclosure starts, and it starts when a bank first filed legal action in court, alongside foreclosure sales, and a sales when properties sold at a foreclosure auction or sale. Analyzing the trends in starts and sales over time provides a clear understanding of the current conditions within the foreclosure market. The term foreclosure is thrown around a lot, and many reporters you see online and on TV do not understand the difference between foreclosure starts and foreclosure sales, so sometimes their results are grossly flawed. Firing up the hype train on foreclosure starts is straightforward, but it's crucial to remember that historically, most foreclosure starts do not lead to a foreclosure sale. Typically, the homeowner manages to catch up on payments, sells the property to repay the loan, or opts for a short sale. During the 2008 housing market collapse, the situation escalated as government actions restricted lending, leading to an increase in foreclosure sales due to the diminished pool of new buyers caused by the scarcity of loan products. The current scenario is markedly different, and in a positive way. Home values have significantly increased, providing most homeowners with substantial equity. If a homeowner falls behind on a loan payment today, they can sell the home on the open market, repay the loan, and walk away with their equity, making the prospect of a foreclosure sale less likely. For years, I've been alerting viewers to the unfolding affordability crisis, so it's with a sense of relief that I can now report a slight improvement in the situation over the past few months. This graph plots the national payment-to-income ratio on new loans. It's the share of median income needed to make the monthly principal and interest payment on purchasing the average price home using a 20% down, 30-year fixed-rate mortgage at the prevailing interest rate. Despite a slight increase in mortgage rates recently, home affordability has improved in the last few months. To purchase a median price home with a 20% down payment on a 30-year fixed-rate loan, it now requires a monthly payment of $2,257. This represents nearly 10% decrease, which is $243 from the record high in October, but an increase of $831, or up 58% from the beginning of 2022. The average payment now constitutes 33.4% of the median household income, a decrease from the 38-year high of over 38% seen in October. However, it remains 9 percentage points higher than the 30-year average of 24.2% and is just below the 33.8% peak observed before the housing market downturn in 2006. I have also highlighted the concern that insufficient homes are being built to accommodate the growing U.S. population. We might be beginning to observe some minor relief in this area, albeit slightly. The national shortfall in homes available for sale, shown as a black dotted line in the graph, saw an adjusted improvement in December, dropping to down 36%, marking its most favorable point since July 2020. This is a significant recovery from the lows of down 51% last summer and down 69% in early 2022. Although the number of new listings remains below pre-pandemic levels by 17%, this gap has lessened from as much as down 31% in March. Inventory levels have improved in 99% of major markets on an adjusted basis over the past 6 months. The most notable increases, ranging between 28 to 30%, occurred in Florida markets, such as Lakeland, Tampa, Orlando, Cape Coral, Northport, and Palm Bay, along with Memphis and Colorado Springs, each seeing a 29 percentage point improvement, and Knoxville and San Jose, both at 25 percentage points. 13 of the top 100 markets with the most significant inventory deficits are located in the Northeast, with Hartford leading at a deficit of negative 79%. If you've been a subscriber of our channel for a while, you'll know that I constantly emphasize supply and demand as a critical lens through which to assess the health of the U.S. housing market. Today's analysis is no exception. This graph displays the month of inventory on the right axis, underscoring the ongoing issue: we have not constructed enough homes to accommodate the expanding U.S. population. With the inventory starting in 2024 at a 36% deficit and demand, as gauged by purchase applications, showing a 38% deficit, the market is seemingly on a cusp of a shift towards more neutral pricing and a gradual increase in sales volumes. This adjustment is particularly anticipated as we progress into the spring buying season, traditionally a peak for real estate activity. The current situation, although not yet aligned with the 5 to 6 months of inventory that define a balanced market, indicates a potential easing of the extreme conditions seen in recent years. As supply and demand move closer to equilibrium, we can expect a more stable market environment benefiting buyers and sellers. If there's one topic completely ignored by YouTube hype channels, is equity in the housing market. Historically, high equity levels act as a safeguard for mortgage investors against potential losses. Additionally, these levels lay the groundwork for a surge in equity lending, anticipated to occur once interest rates lower to a point where homeowners find equity withdrawals more enticing. Mortgage holders concluded 2023 with a record $16 trillion in equity, marking a $1.6 trillion increase, up 11% from last year. Of this, $10.3 trillion is deemed tappable, meaning it's accessible while keeping a combined loan-to-value ratio of 80% or lower, reflecting a $1.14 trillion rise or 12% more in 2023. The average mortgage holder now possesses $299,000 in equity, a growth from $274,000 at 2022's end, with an average of $193,000 available for withdrawal, maintaining a 20% equity cushion in their home. These historically high equity levels serve as a protective measure for mortgage investors against potential losses. Notably, 2/3 of all equity is owned by borrowers with mortgage rates below 4%, creating a disincentive for these individuals, especially those with substantial balances, to refinance their mortgages for equity access. Similarly, an equivalent 2/3 of this equity is held by borrowers with credit scores of 760 or above, identifying a particularly low-risk group for lenders to focus on. The total market combined loan-to-value stands at 45.9%, showing an improvement from 47.2% the previous year, though it has increased from a record low of 42.6% in mid-2022. Despite what the hypesters warned, the current state of the equity in the housing market mitigates the immediate concern for a widespread foreclosure crisis. Ask any bank manager you meet how they would feel with a mortgage portfolio that stands below 50% loan-to-value. I promise they'd take it all day long. The surge in home prices across most of the U.S. has led to very few homeowners finding themselves underwater on their mortgages. By the end of 2023, only 1.1% of mortgage holders, that's 582,000 people, were underwater, a decrease from 1.5% or 807,000 the previous year. The proportion of borrowers with less than 10% equity in their home has remained stable at 5.3%, following a low of 2.2% at the height of the home price increases in the second quarter of 2022. Consider this. I advise most homebuyers that using a low or no down payment mortgage program, such as an FHA loan with a 3.5% down payment and 3% in closing costs, will put them nearly 7% underwater on their mortgage as soon as they move into their new home. Considering the historical real estate appreciation rate of less than 4% a year, I historically recommended preparing to pay money at closing if they decide to sell their home within the first 3 years of ownership. Today, the slow pace at which home builders produce inventory has decreased the risk for buyers and lenders. For instance, in the Tallahassee real estate market, we've observed appreciation rates exceeding 10% over the past 4 years, offering protection to lenders and buyers. Something I never thought I would see is buyers purchasing a new construction home and having to move within a year, being able to sell their home and walk away with money. The low inventory of homes for sale has made these crazy times. Let's close today's video with one hard fact. There is no foreclosure wave in the foreseeable future. The ICE McDash team has my gratitude as it gives us the numbers needed to squash the hype that's so prevalent online. Here's the real information you need to know about delinquencies and foreclosures. Delinquent loans fell 2.8% last year. Foreclosure sales fell 3.6% last year. Foreclosure starts fell 11% last year. Seriously, delinquent loans fell 22% last year. Somehow, even with all this free data available online, the hypesters continue to report a coming wave of foreclosures. Shame on them for using scare tactics to generate views, and congratulations to you for being smart enough to find the facts. In the comprehensive analysis of the current housing market, our examination of mortgage delinquencies, foreclosure rates, and homeowner equity reveals a situation far from the catastrophic forecast often presented online. The empirical evidence strongly indicates a market characterized by stability rather than volatility. Homeowners, by and large, maintain secure positions in their mortgages, underscored by significant equity levels that safeguard against the risk of foreclosure. However, the stability in mortgage holdings contrasts sharply with a broader, more pervasive housing crisis marked by escalating home prices, increasing rents, and the growing financial burden these costs impose on American families. The data compellingly points to a critical issue, not of foreclosure, but of affordability and accessibility in the housing market. The challenge is not merely one of market dynamics, but a structural shortage of housing supply that fails to meet demand. The urgency now is to shift the focus of public policy and private sector action towards expanding the housing supply. This necessitates a concerted effort to address and overcome local resistance to development, often epitomized by the "not in my backyard" or NIMBY sentiment, which hampers construction efforts and exacerbates the housing shortfall. It is imperative to advocate for policies that facilitate, rather than hinder, home building, ensuring that the construction of new housing can proceed at a pace sufficient to meet the pressing demand. The call to action is clear. Policymakers and stakeholders must prioritize the expansion of the housing supply to address the root cause of the affordability crisis. This involves a strategic reevaluation of zoning laws, incentives for builders, and a comprehensive approach to urban planning that collectively aims to increase the availability of affordable housing. While the fear of widespread foreclosure crisis may be unfounded, the concern for home affordability and the need for a substantial increase in the housing supply is unequivocally supported by the data. If you want to see a video featuring my 9 tips for buying a home in a highly competitive market, you can view it by clicking on the box on the left side of your screen. To see a popular video featuring my top 6 home selling tips, just click on the box at the right. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.